This just happened. While Wall Street was sleeping, one city absorbed more physical silver than the entire US banking system could deliver. And what I'm about to show you will change how you see money, banks, and power forever. The banks lost control, and they lost it to something nobody saw coming. Like this video if you think the financial system is hiding something from you. Subscribe now because what happens next will shock the markets, and we're breaking it down first. The year is 2025. Silver prices just did something extraordinary. We're talking about a metal that started the year at $2.29 to $30 per ounce. By December, it peaked above 483s. Do the math. That's roughly 145% in a single year. 145%. That's not normal. That's not a market functioning like it used to. That's a market breaking under pressure. But here's as what they were not telling you. This wasn't just rich investors buying up shiny metal and stuffing it in safes. This was something far more urgent, far more real. This was cities and regions worldwide saying to the banking system, we don't trust your promises anymore. We want the actual metal. And the banks? They couldn't deliver. They stood there, frozen, with contracts for silver they didn't physically own, with promises they couldn't keep, with a system that's only now being exposed as hollowed out and fragile. So what happened when the physical demand hit? Everything changed. For decades, the silver market worked under a comfortable fiction. There was the paper silver market. Futures contracts, derivatives, complicated bets on price movements, and there was the physical market, the actual metal. The two existed in what traders call equilibrium. They danced together, prices tracked between them roughly. But in 2025, that dance shattered. Let's zoom in on what happened. Global silver supply just couldn't keep up with demand. We're not talking about a slight shortage, we're talking structural. As in, it has now been 7 consecutive years of global supply deficits. 7 years. That's the third year in a row that demand exceeded supply by massive margins. In 2024 alone, the deficit hit 248.9 million ounces. Over the 3-4 years from Tudor 2021 to 2024, the combined deficit reached roughly 678 million ounces, equivalent to nearly 10 months of global mine supply. Think about that. A 1 decade's worth of supply just vanished, consumed, used up. Gone into solar panels, electric vehicles, semiconductors, data centers, medical equipment, and military applications. All of it consumed, not circulating, not recyclable in a meaningful way. But that's not the shocking part. Here's what happened next. Industrial demand for silver hit 6 record highs. In 7's 2024 alone, industrial demand surged to 680.5 million ounces, the 4th consecutive record. And that was before the 2025 explosion, the rise of electric vehicles globally, particularly in China and Europe, the solar boom, the data center arms race as everyone tried to build AI infrastructure, Samsung's new battery that can take an EV 1,000 miles on a charge. Each one needs roughly 2 kilograms of silver. Military applications, defense contractors, every Tomahawk missile fired uses about 3,500 ounces of silver. Silver wasn't just valuable anymore, it was becoming essential, critical, irreplaceable in the modern economy. And the supply chain simply couldn't handle it. Now here's where the real story gets interesting. Because when demand becomes inelastic, when people need something regardless of price, the only variable left is supply. And supply is locked. Why? Because roughly 170% of all silver produced globally comes as a byproduct of mining other metals like copper, zinc, and lead. You can't just decide to produce more silver by raising its price. The mines are already operating at their limits. You need to find new deposits. That takes 2 decades. You need exploration capital that dried up over the past 10 years. You need ore grades that have been steadily declining. And you're competing against geopolitical complications, trade wars, and export restrictions. By November 4th, 2025, something unprecedented happened at the Shanghai Futures Exchange. Silver inventories hit their lowest level since 2015. In a major global trading hub, one of the 3 pillars of the world's precious metals market along with London and New York, there was physically less silver available than any point in a decade. The lease rates spiked. Lease rates are what it costs to borrow physical silver. When there's plenty of metal, borrowing it is cheap. When it's tight, rates explode. By late 2025, lease rates had reached levels not seen since before the 2008 financial crisis. And this wasn't just happening in Shanghai. In Japan, on secondary market platforms like Mercari, the premium on physical silver surged to as high as 60%, 60% above the spot price. That means someone buying physical silver in Tokyo was paying 60% more than the official price quoted in futures markets. Why? Because the actual metal, the deliverable physical stuff, was scarce. The paper market and the physical market were screaming at each other. In Dubai, the same story. Premiums climbing to around 940% above spot. India, record purchasing of both physical bars and ETFs, mint shortages, inventory crunches, retail investors and central banks alike, all chasing the same dwindling pool of actual metal. Then came November 10th, 28th, 2025. The Chicago Mercantile Exchange is the world's largest derivatives exchange. On November 11th, 28, the trading center experienced what they called a cooling failure at their primary data center in Aurora, Illinois. The outage lasted 12 over 10 hours, all trading halted. Billions in contracts frozen mid-execution. The timing was extraordinary. Silver futures were approaching historic breakout levels above $13.54 per ounce, levels that would devastate anyone holding massive short positions in silver, anyone betting the price would fall. Within minutes of the halt, spot silver, the actual real-world price, dropped $14.1 in over-the-counter trading despite CME prices being frozen. Then it recovered violently. Gold printed $215 $40 liquidation wicks that instantly reversed. The technical pattern screamed one thing: extreme stress, market plumbing failure. Was it mechanical? Possibly. The infrastructure upgrade was announced just 3 days prior. But the timing raised questions nobody could quite answer. More importantly, what happened as we moved into December? JPMorgan Chase, the largest bank in the United States, holding positions that industry analysts tracked closely. According to SEC disclosures and financial forensics, JPMorgan was on the hook to deliver more than 17,592 tons of silver it didn't own. They had sold short, betting the price would fall. They planned to buy back cheaper. That's called a short squeeze. When the price rises, the short seller gets squeezed. But by late 2025, JPMorgan was facing what one analyst calculated as potential exposure of up to $18, $13.7 billion if the position went wrong. The bank had even shifted dramatically in 2025, buying 19 physical silver, trying to cover their exposure. Insiders claimed they now held 20 over 750 million ounces of physical silver, a historic accumulation. Were they panicked, or strategic, or both? Then came the margin call rumors in late December. Stories spread across financial social media claiming that major bullion banks were under pressure, calling on the Fed's emergency repo facility for liquidity. Claims that one systematic important bank had failed a massive margin call. That emergency liquidity injections had totaled over $21.50 billion. Major news outlets didn't confirm the bank collapse story. The SEC remained silent. The CFTC had no public statements. But something undeniable was happening beneath the surface. Repo facility usage spiked to $22, $25, $26 billion during late December, elevated enough to trigger discussion among market observers, though officials claimed it was routine year-end funding. But what was undeniable? The paper markets and the physical markets were in full dislocation. Now here's where the narrative shifts. Because it wasn't just that banks couldn't deliver, it was that someone else could and did. Throughout 2025, certain cities and regions became the absorption points for physical silver flowing out of the paper market system. When contracts couldn't be satisfied with guaranteed delivery from CME warehouses, when banks couldn't meet physical demands, the metal flowed elsewhere. Shanghai absorbed unprecedented volumes. Trade flows show massive inflows of physical silver into the region, with local refiners and dealers reporting record purchases. The city transformed into an alternative clearing system for physical metal that the traditional banking channels couldn't UDT process. Would it be Mumbai and India's key trading hubs? By mid-2025, Indian investors had already purchased 2 record levels of both physical silver and silver ETFs. With the gold price soaring above $4,300 per ounce, retail investors in India shifted to silver as an affordable alternative store of value. Cities across India became accumulation points for physical metal, draining global supply flows. Dubai positioned itself as the Middle Eastern hub for bullion trading. With 440% premiums on physical metal compared to paper prices, wealthy Middle Eastern and South Asian investors were willing to pay up for deliverable, tangible silver they could hold and store locally. Even London, the historic center of precious metals trading, saw inventory stress. The LBMA, London Bullion Market Association, reported tightening conditions. What for decades had been a reliable source of physical delivery became just another stressed market crying out for metal. The pattern was clear. When the banking system's paper market couldn't deliver, cities and regions with local refiners, dealers, and direct buyer connections simply absorbed the demand. They became the functional replacement for what the banks could no longer do. This is systemic disintermediation, the banking system being cut out, the flow of silver rerouting around Wall Street and the City of London. Let's be absolutely clear about what's happening. Silver is designated a critical mineral. The U.S. military depends on it. Defense contractors need it. The entire green energy transition, solar, wind, EVs, grid infrastructure, all of it requires silver at scales never before demanded in human history, and the supply chain just cracked. When demand for a critical commodity exceeds supply for 7 consecutive years, you don't fix that by tweaking interest rates or printing more currency. You don't fix it with central bank speeches. You need new mines, new productive capacity, new investment. All of those things take decades. Meanwhile, the paper markets, the derivatives, the futures, the complex leverage structures that supposedly allocate resources efficiently have disconnected entirely from physical reality. You can have CME contracts saying silver is worth $2.73 per ounce, while actual deliverable metal in Tokyo trades at a 60% premium. That's not a market. That's a broken system. And as cities and regions stepped in to fill the void, what they revealed is that the physical economy no longer trusts the banking system's promises. They want metal, real metal, deliverable metal, metal they can touch and store. So what happens next? Here's where it gets seriously concerning. Goldman Sachs has set a gold target of $4,000 per ounce. If the gold market cracks higher, driven by the same scarcity dynamics we re-seeing in silver, it could trigger cascading margin calls across the banking system. Banks holding massive amounts of both metals and leveraged positions could face crisis conditions. More immediately, we're entering 2026. The silver deficit continues. Industrial demand for solar and EVs is accelerating, not slowing. Central banks in China and other nations continue quietly accumulating gold and silver. Physical hoarding is accelerating in uncertain times. If demand for physical delivery continues at current levels, and if cities continue to absorb what banks can't deliver, we're heading into a scenario where the paper markets and physical markets diverge even further. We could see 300 plus silver prices as a consequence, not as speculation, but as reality reflecting the actual supply-demand imbalance. Comment below. Do you think the banking system is still functional, or is it being replaced by direct city-to-city, merchant-to-merchant trading? We want to hear your thoughts, and we're reading every single comment. The title of this video said, "One city just absorbed what banks couldn't." It wasn't really one city, it was many. Shanghai, Mumbai, Dubai, Tokyo, London, all stressed simultaneously. All absorbing physical silver that the traditional banking system could no longer deliver. All revealing that when the stakes are real, when you need actual metal and not paper promises, the system breaks. Cities and merchants step in. Direct connections. Trust based on tangible assets, not promises from institutions that have already proven they can't deliver. This isn't a prediction. This is what happened in 2025. And the implications for 2026 and beyond are only beginning to unfold. If you want to understand how the global financial system actually works when it comes under real pressure, subscribe to this channel. We go deep into the stories that aren't being covered, the data that doesn't make headlines, the structural shifts that will reshape wealth, power, and geopolitics over the next decade. Like this video if you think transparency about the financial system matters. The algorithm suppresses content like this, but if you engage, it reaches more people who deserve to know. And in the comments, tell us, what do you think happens next? Is silver heading to $100? Are cities about to replace banks as the clearing mechanism for global trade? We're tracking this story in real time, and we want your insights. Thank you for watching. The break in the silver flow is only the beginning.